Morning, Steve Frost. How are you today?
Hey man, I'm doing really good. How are you?
I'm terrific. So let's get right into the juice. So what's going
Yeah,
on
let's
with these
do it.
interest rates?
You want to talk about rates?
Oh, yeah, rates. What's going on?
Oh, all right. I thought this was the fitness podcast I signed up for. No, I'm just kidding. No, yeah. So rates have had kind of a bum run, and by that I mean rates went up, and so this is very similar to what happened last year with mortgage rates. So at the end of the year, we saw a bunch of declining inflation data and it brought rates down. And then
Mhm.
right as we started getting January economic data, all the rates went right back up because it was all bad for inflation. So we saw the non-farm payrolls 2 weeks ago, which is the government jobs report, showed a massive um, hiring gain for the month of January, which again, and look, I mean, you call it what you want. Is the government playing tricks, or are we really? Are there really that many jobs being created, and we're losing the battle on inflation and things like that? There's a lot of different perspectives to look at it. The fact of the matter is, though, just the data is that the January jobs number is always really hot, even though the bond market and bond traders know that they still trade on whatever the data is. But there are always these seasonal adjustments that come into play. So we saw that happen 2 Fridays ago. And then this week we had the consumer price index, which is CPI. So that's the price we pay for stuff. So the Federal Reserve looks at really two reports for inflation. They look for the consumer price index, the prices we pay, and they look at personal consumption expenditures, which is called PCE. And so that's how much money we're spending. So PCE shows you behavior, right? Like that is showing you consumer or citizen sentiment, right? The other one is the CPI is just price growth, right? So you're just looking at both of these things. So the Federal Reserve, while they both matter, they look mostly at the PCE, personal consumption expenditure. So that's the number they really want to see get to 2% or less for a 12-month average, right? So this week we got the consumer price index, which came in that's the CPI. So the headline number came in at 3%. And when you take away the prices of food and the prices of fuel, it was
Mhm.
actually prices grew at 3.9%, which is a little bit, the markets were expecting 3.8%. So since it was a little bit higher, it's decreasing. We're down from like 4.3 or 4.4 last year. So year over year, we're in a much better place. Um, but it was higher than we thought. The bond market was really kind of looking for something to go one way or the other. It really wanted the fuel the fire either up, so give rates a boost and raise rates, or was looking for economic data to bring rates down. It was kind of at an impasse waiting on that number. And since that number came in mildly hotter than expected, it shot rates up. We lost about a 0.5% and pretty much put us right at like 7% as of Wednesday. Yesterday, some of the Federal Reserve guys came out and they said, "Look, we're not we're not looking at the CPI or the Consumer Price Index as much as we are looking at the Personal Consumption Index, Expenditures Index," and it actually helped interest rates. So interest rates yesterday, we gained about a quarter of that back, and we're off to a really nice start today.
Mhm.
Looking at some of retail sales numbers again, which is it's not that influential of an economic report, but it does give the Federal Reserve a little bit of a look into consumer spending, and we did spend less money in January, which is a good thing. So rates, we're still trading in that 6.5 to 7% range, and it's going to take, the trend is still our friend. We're still improving on where we were 60, 90 days ago. And I think as the year goes on, we'll continue to see rates come down. It's just going to be a bumpy road. There's going to be some ups and there's going to be some downs as we go. The good news is the PCE, or that consumption expenditures index that we look at, that'll come out, I believe next week or the week after. That number has been the run rate on that. If you look at the 8-month average, has been below 2%. So the retail sales today kind of gives us an idea of like, okay, like that's good. That's a behavioral one that came in. That was a big miss. It came in way lower than we thought. And then we're looking at next week, we're going to get another one of these big ones. So hopefully for all of the home buyers out there or the real estate agents out there that have clients getting close to being under contract, or if you're looking at refinancing out of some of those 7% rates, ideally next week would be a rate that you'd want to pick up the phone and check in on some things and see if things improve. So that's what happened to raise the rates the last 2 weeks. Gives you an idea of where rates are today, and then what we're looking forward to as we decide, do we float our rates or do we lock our rates, or how do you want to play that game?
Perfect. And we talked about I think we did touch on that last week, right, Stevie? This is not going to be a road where it's a straight downward path. It's going to be some bumps and bruises along the way to get us to where we want, right?
Yep, it is. And
Yeah.
again, because the whole thing, like I've said before, if the Fed just came out and said, hey, it's time to pivot, it's time to change our policy, it's time to start the process of unwinding some of what we've been doing, which is making it much more restrictive. And so what is all that code for? Would be, we're going to start lowering rates, or we're going to stop letting bonds and things run off the balance sheet. As soon as they make that statement, we see a massive change. It's just the fact that they won't let go of that. And they just don't. And the reason for that is, and the thing that they're really scared of is they don't want to go spend 18 months or 2 years or whatever it's been, a very, very restrictive, very high rate policy. They don't want to pull back from that and have inflation really spike back up on us, or have the markets really take off, because the pain of getting inflation back down if they stop too early is far greater than spending a few more months at the current rate. So they really just want to see that the policy that they have in place has made these changes. Now, if you look at it, a lot of the reason that we're suffering from all this inflation came from stimulus. This all came from a global pandemic. This was not a normal economic cycle that led to all this. So the growth rate of inflation has been decreasing dramatically for the last 18 months. Like, what they're doing is working, and it will go down. So it is, from an economic guy who studied this and really dives into this like I do, it's just, they're going way too long. Now, obviously it's good for my business to say they should lower rates, right? Like, I want that to happen, but even just from an economic perspective, they don't have to keep going.
Got it.
But I don't get to make the rules.
All right. Well, before we get out of here, I'll touch just a little bit on the housing market. So year over year, looking at home prices nationwide, we're up 6.1%. So even with all the bumps and bruises that we had last year, your home still appreciated 6.1%. And if you're in Metro Detroit, you can pat yourself on the back even more, because we went up 9%. So if you own a home, you pretty much gain 9% equity, which is huge. Now, why did this happen? It's because our inventory levels, as we touched time and time again on these episodes, is still at historic lows. I mean, we're nationwide, we're 4.2, which is getting a little bit closer to more of an average. But I mean, like 6 to 8 is really where your average market is, where it's completely balanced. And here locally in Metro Detroit, we're still at 1.7 months inventory, which is very, very low. And pretty much what that means is it will only take a month and a half to pretty much sell every house that's on the market right now. So even with a little bit of buyers going kind of a little bit back to the sidelines, still every house that's coming on the market is getting tons of showings, and if it's priced right, it's getting multiple offers, because there's not much to choose from still at this time. Other than that, I don't have much other to touch on. What about you, Steve?
So just some like financial strategy thoughts for a 9% increase in property value. So if you think about, if you bought your house even 2 years ago and you're paying mortgage insurance, um, lenders do not just drop mortgage insurance based on your property value. So until you actually rattle the cage, they're going to look at your mortgage insurance, or your PMI, right? So if you put down less than 20%, or if you have an FHA loan, or if you put down less than 20%, or you have an FHA loan, if you think about it over the last 2 years, right? So what do we see in 2022? Is it like 11% or something
Yeah,
property
it
value
was something
increase?
crazy. Yeah.
And then we saw 9% last year. If you have a $250,000 home, you now have a $300,000 home is what these numbers are saying. And so is that true in every case? No, absolutely not. But one thing that you can do is pick up the phone and call your mortgage person, or you can call me, you can do whatever you want. But the amount of money you pay in private mortgage insurance is based on how much you owe on the home compared to the value of the home. So I have clients who I've been talking to that have looked at said, "Hey, Steve, I'm paying like 7% and I've got this PMI. Is there anything we can do?" Because we call all of our clients every year, right? Like, any questions on your mortgage? Yeah, I'm paying 7%. Green rates are coming down a little bit, and my PMI is $163 a month. Well, when I go back and look at that now, I'm like, look, if the house appraised, if you put down 5%, we did this transaction, and now we look at it and we look at some of the comps in your area, and the value is now going to put your loan to value at maybe like 88. That PMI went from like 163 a month to like $59 a month. So now you're talking about $100 a month savings in PMI, which PMI, you can't eat it or drive it. So you might as well not pay any, you want to pay as little as you can, right? And then we can also look at getting you a slightly lower rate. So now you're taking yourself out of paying as much in PMI, a little bit lower monthly payment on the interest. And then you also skip a payment. So they're like, hey, this is great. I'm going into the new year. I get to skip a mortgage payment. I pay a little bit less in PMI thanks to my property value. My rate's a hair less. Like, this makes a lot of sense. Cover a good amount of the closing costs for you. And all of a sudden, you have a transaction that is going to help you for the next 12 months by saving you the money, and you get that skip payment, maybe get an extra $1,500, $2,000 in your pocket this time of year. It never hurts, especially as you start, if you're like me and you're about to write a fat check for spring break, or if you're trying to recover from all the money you spent during the holidays. It's like, it's just a nice review to have on your mortgage.
Yeah, perfect. Thanks for that, Steve. And I'll go ahead and I'll put your phone number and I'll link you and or tag you in this post as well. So if anyone needs to reach out and has any questions regarding that, they can do so. I'll put my phone number in here as well as my email if you guys want to reach out to me. Anything else?
That's it, man.
All right,
That was my
perfect.
play. I didn't mean to do a shameless plug. I'm just telling you. You don't have to call me. You can, but you don't have to.
All right, Steve. We'll see you on the next one.
All right, man. Take care.